Welcome to Morning Brief. I'm Julie Hyman. Here's what you need to know today. First up, U.S. stocks are trading near record highs ahead of key economic data, including the U.S. jobs report and the latest read on inflation. This morning, we already got an economic data report, retail sales from December showing no growth. And we're going to talk much more about the state of the consumer throughout the show. Plus, investors are betting on another century of Google parent Alphabet. According to reports, Alphabet's selling $1 billion worth of bonds that won't mature for 100 years. It is the first tech company to offer the long-dated bond since Motorola in 1997. Of course, we're going to be talking a lot about the tech trade today as well. And keeping an eye on some earnings movers this morning, Coca-Cola's results underwhelmed investors after its outlook came in at the bottom end of its range. Meanwhile, Spotify's getting a boost after the company said monthly active users jumped 11% from a year ago to 751 million. We're going to have more earnings coverage throughout the show, including the takeaway from our interview with Coca-Cola's outgoing CEO. All right, let's get a check-in on stock futures here this morning. After a couple days of gains, we're looking at a mixed picture this morning. But I should remind you, yesterday at this time, we were also looking at, a slightly mixed open. And then, of course, we saw things improve throughout the day. So the Dow right now showing a decline of about 10 points. The S&P futures up very slightly. NASDAQ 100 futures up very slightly. So let's talk about and dig into what's going on underneath the surface in this market. There's a lot to break down, from the software sell-off and rebound to a slew of earnings. So joining us for more, Yahoo Finance executive editor Brian Sozzi is with me in the studio this morning.
Julie, it feels so serious. You're like walking over to me like now I wasn't nervous, but now I'm really nervous.
You should be nervous.
All right, go.
You should be nervous.
Hit me with these tough questions.
Okay, so first I want to talk about what's going on with stocks being near a record. So the all-time high was on January 27th. That was the all-time high close, 69.7860. We closed just about 10 points very or so precise. Below that. Very precise. You know me, I'm very precise. I'm very precise. But I will say, with the upward sort of sideways movement we've had in the market recently, the vibes are not excellent. Mm-hmm. Even with this rally that we have seen, it doesn't feel like a very loved and enthusiastic rally, does it?
And that sucks, because I think investors have really gone down the rabbit hole that software stocks are the only stocks that trade in the entire stock market, and when they go down because of a new model update out of Anthropic or OpenAI, these are the only stocks that matter. But I encourage everyone to push those stocks aside for a second and realize there are like 490 other stocks on the S&P 500, and those companies have reported pretty darn good earnings. We're getting earnings beats, we're getting sales growth, we're getting earnings growth. What else do you want out of corporate America in this backdrop?
Well, the discussion, the sentiment may be around the software stocks and tech, but people are buying those other stocks, right? Energy's the best performing group this year. Materials come in number 2. Consumer staples, yawn, boring. Consumer staples are number 3. Number 3. And industrials are number 4. And so, it feels like that there is that rotation going on. The fly in the ointment, I guess, is that it's going to be real hard for tech to continue a rip-roaring rally, or for the stocks market overall, without tech, because tech accounts for such a big weighting. So everything else can go up without a huge rally in the index.
I go back to what I wrote in my Sunday morning brief newsletter, free plug there. I mean, go back and read it. I think it's all still completely relevant. You're unlikely to get a bottom in software stocks until we get a sign of what the real terminal value of these companies are as AI gets more powerful. And I hope I didn't lose anyone by breaking out CFA textbook lingo, but that stuff matters. That's what the stock market does every day. They tries to figure out the future earnings of companies. And right now, the market is saying, I have no idea how much ServiceNow or ServiceNow will be earning 5 years from now. No clue. And until I have a better idea, I'm just not buying that stock. And it's not just ServiceNow. It's even a company like Salesforce, Julie.
But they do have visibility on that other stuff we talked about, energy and industrials. The irony is, in part, because energy and industrials are increasingly feeding the power into AI. So back to the picks and shovels trade, as everybody has been calling it.
Salesforce is not going out of business. They still need data centers, and they need oil. They need oil, Julie, to power these data centers.
And we know Alphabet is doing a 100-year bond sale and spending $200 billion
Look, bottom line, listen, none of us are going to be alive in 100 years. It's going to be a world run by humanoid robots from Elon Musk, Julie. So go out and get that Google bond. It doesn't matter. Grandfather it to your kids down the line. Who the hell cares? I mean, we're not going to be around. It doesn't matter.
I mean,
is Google going to be around 100 years?
Alexa's going to kill us, like Chris Hemsworth said during the Super Bowl.
You might be right, Julie.
Okay, let's talk about another area where perhaps there is not great visibility, and that's with the consumer. We just got retail sales numbers this morning that showed no change, right? And that was considerably worse than expected. Economists were looking for 0.4% gain, and we're talking December here. We're talking what's supposed to be the holiday spending.
Old news alert.
Oh, why? But is it? I mean, it's a little bit surprising here to see this number. No.
No, I'm making fun of a little bit. If you've been bulled up on stocks, or if you've been encouraged by what the consumer has done, especially on the high end, you see Walmart out there breaking through $1 trillion market cap. You didn't want to see this retail sales report, and it wasn't just a headline. You double click on this report, Julie, and every line item stung. Building materials, furniture, clothing, even with the weather getting bad. So none of this was signaling to me, wow, let's go out there and buy some retail stocks. Like, that's not the vibe I got off this.
Yeah, I mean, to do a deep dive.
To a deep dive.
Or double click.
A double click.
To your point, miscellaneous store retailers down 0.9%. Furniture down 0.9%. These are the month-over-month figures. Clothing down 0.7%. Department stores, no surprise there, down 0.7%. You know what did show strength? Building materials and garden equipment and supplies.
Yeah, we all need rock salt. Julie, can I plug how did restaurants do?
Goods.
I want to plug my Chipotle interview. How did restaurants do?
I'm not seeing restaurants. Oh, food services and drinking places down 0.1%.
Okay, good. That fits perfectly. I had a great conversation with Chipotle CEO Scott Boatwright. I asked him, Julie, he's facing a little bit of backlash about what he said on the earnings call last week about how they're raising prices on high-income consumers. He didn't actually say that. Nonetheless, I asked him about it.
60% of our consumers' average household income is over $100,000 a year, and they're still spending in this tough economy. So we're going to lean into those consumers with brand innovation, menu innovation, and really give them more compelling reasons to come in.
So bottom line, if you make over $100,000, you could get double protein at Chipotle, and you're rocking and you're fueling that company's sales. Now, I will say this, if you're making $100,000, what Scott's coming out with now, a new happy hour, he told me here on Yahoo Finance, hasn't told anybody else about it, but they're about to test a happy hour.
Like with booze.
No booze. We're not talking about margaritas. We're not talking about getting liquored up at Chipotle, Julie. We're talking about maybe 3 tacos and a drink for maybe $8 or $9. Yum. Love it all. It's great.
I will say, and you and I are going to talk to the Marriott CEO a little bit later on as we try and figure out in this thicket what's going on with the consumer.
Not a great quarter for Marriott.
One call out I will make, luxury hotels continuing to outperform. And so what that says to me is the whole K-shaped thesis is alive and well. That is,
draw it for us.
Anyone
what
who
is the K-shaped
anyone
economy?
See, it's true.
Okay.
Anyone who is in the market, owns real estate, who is making more, whose assets are appreciating, is more willing to spend. The people on the bottom end of the K who don't make as much, who don't own stocks, who don't own real estate, they're not doing
well. I know you love hanging at the Ritz-Carlton, Julie. That's your vibe.
Of course.
Their revenue per available room at Marriott, that's a key industry metric, up 7.1%. You go down the line, more of those Sheraton hotels that the cost-conscious self that is me likes to go at, up really just a little bit. So that high-income, low-income vibe, you saw that Marriott result.
We'll talk about how many cars you own offline. Brian,
we're going to keep it offline. I go to Sheraton, Julie. I'm a humble guy.
That's because you're spending all your money on the cars.
My watch is nice, right? It's really shiny. Yeah, there we go. Yeah, really good.
You're a choiceful consumer.
Did I deliver for you?
Yeah.
Thank you.
Come back anytime.
Thanks for having me.
All right. Thanks to Brian. And tune in at 10:40. He's going to be back, and he and I will be talking to the CEO of Marriott about the
Tony's
company's
a big watch guy too.
Latest earnings. We'll ask him what he's wearing. All right. Let's talk about another big consumer company that we have to touch on this morning. That's Coca-Cola. The bottom end of its full-year sales outlook coming in below estimates. Still, the company seeing strength in its zero-sugar soda. Senior reporter Brooke DiPalma here with me with the biggest takeaways from the results. And I was also interested to see the company's been raising prices.
Yeah, the company has been raising prices, specifically here in the U.S., up about 4% for the quarter. But surprisingly, volume was actually up in the U.S. about 1%.
Right, so not a huge gain.
Not a huge gain, but still surprising when
Yeah.
consumers really have been pushing back on higher
Right.
prices quite broadly. But what we did see was that Wall Street really was quite upset about the outlook that they had put out. The company said that it expects organic revenue growth of about 4 to 5%. That was slightly below what Wall Street had expected of roughly 5%. And I asked James Quincy, outgoing CEO, on the phone this morning what exactly his response was to that outlook. And he said this. He said, quote, "We've taken what we think is a realistic but prudent approach relative to a number of international markets we need to see improve through the course of 2026. Let's drive the top line approach. Let's drive the portfolio. Let's get a balance of volume and price." And Julie, he mentioned some key markets that were also under pressure. That includes China, India, and Mexico, where they actually implemented a soft drink tax. He said the region sort of needs to develop from there and really take this with stride, but also bringing it back here into the U.S., as we were alluding to. We did see that unit case volume increase. And so I asked him, what exactly is happening with the state of the U.S. consumer? And this is what he said. There was strength in that Coke Zero, that zero sugar brand. He also said that Diet Coke and Protein, their core power and Fairlife are doing well for them. Also, hydration, water brands doing well as well. That was pretty interesting. We also have this GLP-1 effect, where about 25% of U.S. households now have about one GLP-1 user, which was surprising to me. He said that given their total brand business, they're well positioned. Also, I asked him about the K-shaped economy. I said, are you seeing it? And he sort of described the K-shaped economy to me, but he said, hey, total spending is up, but low-income consumers are looking for more value, price pack architecture, these lingo keywords we're hearing.
Price pack architecture.
That's the jargon we've been hearing for
that just
years
means they
now.
want to buy something smaller for cheaper?
Exactly.
Or that's what Coke
maybe,
is offering
maybe
them?
they're getting an 8-pack as opposed to a 12-pack. And they're also going to the dollar store, the lower-income consumer, to shop for their Coca-Cola these days as well.
Interesting. Okay, so they're not immune to those kinds of pressures.
Yeah, they're ultimately seeing consumers continuing to splurge on Coke. They're saying that both high-income and low-income consumers are spending, but they're just seeking out different options. And so they're playing into this affordability conversation that's happening right now.
Are you a Coca-Cola drinker? Do you buy this stuff?
I will admit, I am not a soda drinker, Julie.
Neither am I.
Yeah.
What about, we know Brian Sazzi's still on set with us.
I'm still on set. I have lots of things to say about this Coca-Cola and PepsiCo quarter. I like Coke, and I know executives are going to come in here and say,
you like Coke the stock?
I like
Coke Zero? You like drinking Coke?
I like zero sugar, and I know executives won't come out and say, oh, we love Coke or Pepsi. I'm here to tell you, Coke Zero is my soda, and I'm okay. But I do like to do Pepsi probiotic.
So I will say on that Pepsi probiotic, I asked him. I said, your competitor is getting into this probiotic. PepsiCo bought Poppi for $2 billion. That acquisition closed earlier in 2025. And I said, how's that Simply Poppi or Simply Pop probiotic soda? He said they're still in the early innings of it. They're taking lots of learnings. Doesn't seem like it's quite working as well for them. That's something that consumers really want right now. They want like a prebiotic, probiotic soda brand. Doesn't seem like Coca-Cola has been able to win over consumers with their option just yet.
Can I just add one thing? So Ramon LaGuardia, PepsiCo CEO, will continue to come on with me. I love the new snacks. I tried them out for the Super Bowl. I tried the Super Bowl. They came out like these Doritos with no coloring, and they still taste like
the same?
They taste like Doritos. I tasted the
Is
cheese
it
on my
nacho
tongue.
cheese
I think it was great.
And Cool Ranch?
It was just, I tasted something that resembled cheese, and I think it was great. I think it was great. This is innovation. Now you know why consumer staple stocks are trading at like highs again. This is the innovation we need, Julie. I know you're a big food person.
Well, it's innovation. It's forced innovation in that case, right?
Consumers are seeking that out.
It's consumers, but it's also the government now is putting they're encouraging. It's voluntary.
So I need to thank
but they are
RFK
encouraging.
for Doritos.
They are encouraging these companies to abandon those petroleum-based dyes.
Yeah,
Thank you,
preservatives.
RFK, for my naked, no-colored new Doritos.
I got to try these. I didn't even know they existed.
them
You don't eat
too.
any of that stuff. Come on, you don't eat that.
I like Doritos.
Really?
I don't drink soda. I do occasionally.
But no Wingstop.
I like an
Doesn't love a
occasional
good
No
Dorito,
Wingstop.
right?
Right? Yeah.
We'll talk. You know how I feel about Wingstop.
Both
Okay.
stocks up more than 10% year to date.
Okay, there we go. Thank you, Brooke. Bringing us back to some sanity here. All right, coming up in Morning Brief, we're bringing you today's top trending tickers and count you down to the opening bell. We'll be right back. Now, Now time for some of today's trending tickers. We are watching Paramount, Spotify, and Harley-Davidson. First up, Paramount Skydowns. The company has, again, enhanced its offer for Warner Brothers Discovery. In a statement, the media company said it enhanced its, quote, superior bid for the studio with what it's calling a 25 cent per share ticking fee. I have never heard of a ticking fee before. It would be paid to Warner Brothers shareholders for each quarter the transaction has not closed beyond December of 2026. Paramount says it's also going to fund a $2.8 billion termination fee to rival bidder Netflix. Among the many announcements, Paramount says it has secured clearance for its offer from German authorities. We'll see if that changes the calculus at all when it comes to Warner Brothers. Next up is Spotify. The music streamer added 38 million monthly active users in the fourth quarter. That was well above expectations. Spotify now has 751 million monthly active users. It credited the end-of-year Wrapped campaign to the growth. Remember, Wrapped lets users share their favorite artists, their songs on social media. Spotify also launched an enhanced free tier, which it also said helped its gains. And finally, Harley-Davidson, the motorcycle maker, reported an unexpected drop in shipments in the fourth quarter. Deliveries fell by 4% in the period. Analysts were actually expecting a 22% increase. That was the consensus estimate. The quarter was disappointing pretty much across the board. Sales of $496 million also fell well short of the $749 million called for in the average analyst estimate, and those shares are slumping by 6%. Let's broaden it out once again now and dig deeper into the wider markets as investors remain skeptical despite the sharp tech rebound. David Miller is joining me now. He's the Chief Investment Officer at Catalyst Funds. And David, I was saying earlier to our Brian Stasi, here we are, the S&P 500 is near a record, right? We've seen stocks sort of rise here. It doesn't feel like it though, does it? I don't know. What do you, like the sentiment here, just like we were talking a lot about the vibe session or whatever, that people didn't feel good even if the economic numbers looked good. Right now it feels like we're in a little bit of a similar situation with the market. What do you think?
Yeah, I think there's a lot of moving pieces to that dynamic. Certainly the market has kind of climbed a wall of worry over the past few years. It's actually one of the most persistent rallies on like a 3-year basis or a 4-year basis we've had in quite a while. However, I think there's another dynamic to this, which is what's going on with the dollar and dollar debasement. And if you look at the stock market, say the past 20 years or so, it's not actually up versus if you price it in gold or something of that nature. So there's certainly an argument that if the dollar loses value, just to keep pace, the stock market has to go up proportionally. I think that's part of what we're seeing there. Interesting.
Okay, so do you feel like the reasons that the stock market has gone up or not? I mean, there are fundamentals to support increases still, however, right?
Yeah, absolutely. I mean, if you look at overall earnings growth, they've been pretty good. I mean, certainly there's been concern around software names, but it looks like energy is having a bit of a comeback. So there certainly are some fundamental reasons for that. And gold is certainly up considerably regardless. It's not just an inflation story.
Right. So the software sell-off, would that be something have you come in and bought some of those names?
So we haven't. So there are some real concerns about some of those software names. I think at the end of the day, AI is going to be a net positive for certain software names, and others it's a huge net negative where they can actually be outright replaced. But I think if you look at a company like, maybe one exception is we bought into some ServiceNow, and ServiceNow is one of those companies where I think they'll probably be a net beneficiary of AI. Whereas you look at a company like, let's say, a Monday.com, and it's pretty easy to replicate some of their services through some of these vibe coding type apps.
Okay, so what's the difference between a Monday.com and a ServiceNow in terms of why does ServiceNow have a bigger moat than say a Monday.com?
So first, it's pretty difficult to replicate because there's a lot of infrastructure that needs to be in place for companies that have large customer service operations. So I think that's certainly a benefit that ServiceNow has, whereas Monday.com is a relatively simple piece of software that can be replicated at least for, say, 80-90% of the use cases without that much difficulty.
Gotcha. Okay, so selective buying in software. What about, you mentioned energy, which is the best performing group this year thus far after lagging, for a while. Is that so? Are you participating in this whole rotation that we have seen into some of those kinds of areas, industrials, consumer staples, et cetera?
So we haven't rotated our portfolio a whole lot. We've held a little bit of energy names. We own some Marathon. We own some Talon. But if you look at our portfolio more overall, I'd consider it to be more like durable compounders.
What does that mean?
What that mean is more companies like a Visa or a MasterCard or a Meta, those types of firms that have strong moats that consistently grow their earnings with high margins, high return on equity, high return on capital.
And I want to also talk about some of the other asset classes, right? Because you mentioned gold. And I think that regular investors who sort of got in and then were whipsawed are struggling to figure out what to do now when it comes to gold and silver, because there's the fundamental case, just like there's for stocks, and then there's sort of the technical effects of what happens when people get, positioned in a certain way and then have to make up for that. So how do you square those various things?
Sure. So I guess there's lots of things moving at the same time. So I'd say you'd have the deep currents, which are things like central bank buying or deficit spending on the US federal government level. And those are very strong deep currents. And they likely will take gold higher in a big way the next 3, 5, 10 years. But then you also have some of these things like the recent Fed appointment, which make it unclear. Are we headed for a stronger dollar or a weaker dollar? They're kind of saying two different things. It's not clear. It's clear what Trump kind of conceptually wants, but it's not clear how much Fed independence there really will or won't be. And increases in margin requirements, some of these violent moves like we had in gold or even more so in silver, I think will create a very volatile rally over the next 3 to 5 years. But it's going to be one where you have to wear your seatbelt.
And what about crypto? Does that fall into a similar category?
So I think crypto has kind of lost that digital gold story, and it's become much more clear that it's more just a high beta asset. And I think, frankly, there have been a lot of things distracting people from crypto. Crypto at one point was the real meme stock equivalent, whereas now you have crypto, but you also have meme stocks, you have gold, you have silver, you have a real betification across the economy. And I think that has taken a lot of the capital flows away from crypto.
That's a really interesting thesis. I mean, and we see it also in the single stock movements, not even just meme stocks, but other types of stocks that normally you wouldn't think would move that much are moving a lot. Do you think there's also, because of the crypto washout, that has pushed a lot of money into some of those memes instead?
Yeah, or I mean, I think the memes have attracted a lot of money that might have otherwise gone to crypto.
Gotcha. So does that mean you don't want to be positioned in crypto?
I think crypto is a very binary story, and it's very unclear what that future will look like. It'll either be much, much higher 10, 20 years from now, or it could be that Bitcoin was a fad, or it could get hacked, or people might just not have that appeal to it like they did previously. It's just too hard to tell. But I think of it's a great investment as a call option,
right.
But that doesn't mean it'll necessarily work over the next few years.
When people used to ask me about it, I used to say, don't put anything in it you can't afford to lose.
I think that's definitely a good way to look at it.
I don't know if it's still that way, but maybe. All right. Thanks so much, David. Appreciate it. Coming up on Yahoo Finance is Opening Bid. Our executive editor, Brian Sazzi. I'm in such a rush to get to you.
I'd be excited too, Julie, to come to me. I'd be really pumped up about it.
I'm pretty pumped up.
You are pumped up. We're going to talk all things software. We're going to go into a little Bitcoin. Top of the show, coming out with Superhuman CEO. Excited to talk to him, see if he has a hack for me to get into zero inbox every single day of my life. I think he's the right one to ask.
I am so far from that.
Yeah, I've seen your email inbox, Julie. It could use a lot of help.
I really need that.
Clean it up, Julie.
I will be listening closely. All right, thanks, Saz. That does our morning brief. Opening Bid is next.